The cornerstone of the bullish thesis for Nordic American tankers is its industry-leading operating cost structure, which provides the company with a significant margin of safety compared to its peer group. NAT reports daily vessel operating expenses, OPEX, of approximately $9,000 per ship. To appreciate the magnitude of this advantage, one must contrast it with the broader industry averages for Suezmax tonnage, which typically range between $26,000 and $29,200 per day when factoring in higher administrative overhead, debt servicing, and complex corporate structures. This $9,000 daily cost is not merely a benchmark, it is the fundamental driver of the company's ability to remain cash flow positive throughout the cyclical troughs of the shipping market. When spot rates decline toward historical lows, NAT's break-even point remains substantially below the market floor, allowing it to continue servicing its obligations while competitors face liquidity crises. In high-rate environments, this low-cost base transforms into powerful operating leverage. In the fourth quarter of 2025, for instance, the fleet achieved an average time charter equivalent (TCE) rate of $35,000 per day, a 25% increase over the previous quarter. Given the fixed nature of the $9,000 daily OPEX, nearly $26,000 of daily revenue per ship flowed directly to EBITDA and net income. The implications of this leverage for the 2026 fiscal year are profound. As of early 2026, NAT reported booking approximately two-thirds its first quarter spot days at rates averaging $55,000 per day. At this rate, the company generates $46,000 in net cash per vessel per day. With a fleet of 20 ships, this equates to roughly $82.8 million in quarterly net cash generation before interest and taxes. This cash-backed earnings quality is a primary reason the company maintains a high Altman Z-score of 3.10, signaling a very low probability of bankruptcy, despite the capital-intensive nature of the sector. The second pillar of the bull case rests on the fact that the Suezmax segment is uniquely positioned to benefit from the disruption of traditional trade routes. These vessels are the largest tankers capable of transiting the Suez Canal when fully laden, a factor that has become critical as trade flows between the Atlantic Basin and Asia intensify. Several geopolitical factors are acting as catalysts for Suezmax outperformance. The displacement of Russian barrels. Sanctions on Russian crude and refined products have forced a redirection of flows away from traditional short-haul routes in the Baltic and Black Seas. This has created long-haul replacements where crude is sourced from the U.S. Gulf Coast, USGC, West Africa, and Brazil to meet European demand. The result is a dramatic increase in ton-mile demand, the product of the weight of the cargo and the distance transported.
Conflict in the Middle East and the Strait of Hormuz. Airstrikes on Iranian assets in 2026 led to a near halt in tanker movements through the Strait of Hormuz. While such disruptions create supply shocks that raise oil prices to near $120 per barrel, they also force shippers to seek alternative routes and vessel classes, often benefiting mid-sized tankers like Suezmaxes that can navigate congested ports or utilize pipelines bypassing the choke points. The resilience of Asian demand. Despite global decarbonization trends, China and India have added significant refinery capacity. China alone added 1 million barrels per day since 2020, with another 1.5 million barrels per day planned by 2030. These refineries are increasingly reliant on seaborne crude, much of which arrives via the ton-mile intensive Atlantic routes that favor Suezmax flexibility over the sheer volume of VLCCs. This environment has pushed vessel capacity utilization above 90% by the end of 2025, lifting freight rates more than 60% above their 10-year historical averages. For a pure play like NAT, this translates into sustained pricing power. The chaotic conditions mentioned by NAT management in April 2026 are not merely challenges, but are the primary drivers of more transportation work for the company's fleet.
For the income-focused investor, Nordic American Tankers represents a rare example of a company that has subordinated almost all other corporate priorities to the quarterly cash dividend. As of the first quarter of 2026, NAT has declared its 114th consecutive quarterly dividend. This commitment, spanning 28 years, encompasses multiple shipping supercycles, the 2008 financial crisis, and the 2020 pandemic lockdowns. The dividend policy is explicitly linked to the spot market's performance. Rather than maintaining a fixed payout that could drain reserves during downturns, NAT distributes a significant portion of its free cash flow each quarter. This provides shareholders with direct exposure to the high-rate environments. The annual dividend totaled $0.36 per share. With a forward dividend yield often exceeding 12%, NAT is ranked in the top 15% of dividend-paying stocks globally by yield. The dividend is further supported by the company's strong interest coverage ratio, which stood at a 91x in 2024, indicating that operating income is more than sufficient to cover interest obligations even before common dividends are considered. This transparency allows investors to model their expected returns based on prevailing Baltic Dritty Tanker Index (BDTI) trends, making NAT a favored vehicle for tactical shipping exposure.
The fourth bull case argument centers on the striking scarcity of compliant ships emerging in 2026. The global tanker market has effectively split into two segments: the shadow fleet, or gray fleet, composed of older, often unvetted vessels used for sanctioned trade, and the mainstream fleet of high-quality, fully insured and vetted tankers. NAT's competitive advantage in this environment is driven by its relationships with major oil companies. Roughly 50% of NAT's vessels are chartered by major oil companies, such as BP, Shell, and Exxon, which require rigorous vetting inspections. NAT's technical specifications for ships like the MT Nordic Harrier 2022 and MT Nordic Hunter 2022 reflect state-of-the-art designs that meet the highest international safety and environmental standards. As Western regulators and port authorities intensify their crackdown on the shadow fleet, vessels often over 15 to 20 years old that pose significant environmental risks, the supply of compliant tonnage for mainstream oil majors is tightening. This bifurcation creates a premium for fleets like NAT's. While vintage vessels are sold into the shadow fleet at elevated prices, a dynamic NAT has capitalized on by selling 4 2003-2005 built ships in 2025, the remaining compliant vessels face less competition for mainstream cargo. Furthermore, the implementation of stricter environmental regulations, including IMO Tier 3 emission standards and the Energy Efficiency Design Index (EEDI) Phase 3, will further exclude older, less efficient ships from major ports. NAT's recent order for 2 new buildings for 2028 delivery specifically targets these high-efficiency standards, ensuring that the company remains at the forefront of the compliant market in the decade to come.
The bear case. Despite recent efforts to modernize its fleet, Nordic American Tankers faces a significant aging fleet problem that threatens its long-term operational viability. As of late 2025, the company's fleet of 20 vessels includes several ships that have already crossed or are approaching the 20-year threshold. In the shipping industry, 20 years is a critical inflection point where maintenance costs rise exponentially, insurance premiums spike, and top-tier charterers begin to exclude the vessels from their portfolios. While NAT successfully sold 4 vessels built between 2003 and 2005 during the favorable resale market of 2025, it still retains several mid-age vessels that will require replacement in the near future to maintain the company's high-quality designation. The cost of replacing these aging assets is prohibitive. New build prices for Suezmax tankers have climbed toward $90 million per ship in 2026. NAT's recent order for 2 vessels for 2028 delivery represents a total commitment of approximately $180 million. Given that the company prioritizes dividend payouts, it lacks the massive retained earnings necessary to fund a comprehensive fleet renewal program internally. This creates a capex cliff, where the company must either take on significant new debt or continue its historical practice of diluting shareholders to buy new ships, both of which undermine the long-term investment value. While the current tanker market is undersupplied, the industry is entering a critical new build cycle that could lead to a significant oversupply of tonnage by 2027 and 2028. Shipping markets are notoriously cyclical, and high freight rates invariably lead to a surge in new orders. After several years of discipline, the tanker order book has expanded rapidly, currently standing at approximately 18% of the total existing fleet's capacity. Analyst projections for crude tanker deliveries show a significant escalation in capacity. 2026, approximately 24 million deadweight tons (DWT) of crude tanker capacity is scheduled for delivery. 2027, deliveries are expected to rise to 30 million DWT. 2028, projected deliveries remain elevated at 30 million DWT. This influx of new capacity is particularly concentrated in the larger Suezmax and VLCC segments. The total tanker deliveries in 2026, including products, are expected to hit 49 million DWT, which would surpass the previous historic high of 48 million DWT set in 2009. Historically, such supply surges lead to a collapse in freight rates as the market struggles to absorb the new tonnage. If global oil demand growth slows as projected, the industry could face a prolonged period of lower for longer rates, which would be devastating for a spot market-reliant company like NAT. Furthermore, BIMCO has already warned that the continued market strength is delaying the recycling of older ships, meaning that new capacity is being added on top of an aging fleet rather than purely replacing it. A major deterrent for long-term investors in Nordic American tankers is the company's aggressive and persistent use of its at-the-market ATM equity program and secondary offerings. Over the last decade and a half, NAT has significantly expanded its share count, often to maintain its dividend or acquire vessels during periods when cash flow was insufficient. The growth in shares outstanding has been relentless. 2018, 142 million shares, a 36.54% annual increase. 2022, 202 million shares, a 23.9% annual increase. 2025, 212 million shares. While management characterizes this as growth, it represents massive dilution for original shareholders. A shareholder who owned 1% of the company in 2011 would own less than 0.25% today without significant additional investment. This dilution means that even if the company's total net increase grows, the per-share earnings and dividend potential are constantly suppressed. This equity as a piggy bank model creates a misalignment between management, whose compensation may be linked to fleet size or total EBITDA, and shareholders, who rely on per-share metrics. Although NAT did not utilize ATM offerings in the first 9 months of 2025, the historical precedent suggests that management will not hesitate to issue new shares if capital needs arise for its 2028 newbuild commitments. The ultimate bear case for NAT is the global transition away from hydrocarbons, which threatens the very foundation of the crude tanker business. Oil demand is expected to peak around 2030. Several factors contribute to this outlook. Electric vehicle adoption. Rapid growth in EV sales in China and Europe is already beginning to plateau road transport demand, the largest segment of oil consumption. Fuel efficiency. Advances in internal combustion engine technology and aviation efficiency are reducing the oil intensity of global economic growth. Economic shifts in China. China's transition from a heavy industry and export-led economy to a service-oriented one is expected to decelerate its demand for energy imports, particularly crude oil. As oil demand growth stalls or declines, the ton-mile expansion that has benefited Suezmaxes in 2025-2026 will likely reverse. A shrinking market for crude will lead to intense competition among tanker classes, with VLCCs potentially cannibalizing Suezmax routes to maintain utilization. In such a declining market scenario, companies with high dividend payout ratios and aging fleets are the most vulnerable, as they lack the capital to pivot toward alternative energy shipping, such as LNG or ammonia, and their primary assets become increasingly obsolete.
Synthesis. As of December 31, 2025, NAT reported a total net debt of $306 million, which averages to approximately $15.3 million per vessel across the 20-ship fleet. This debt level is relatively moderate compared to the current resale value of Suezmax tonnage. A 2016-built vessel, similar to several in NAT's fleet, was valued at approximately $65.6 million in early 2025. This implies that the company's loan-to-value, or LTV, ratio is healthy, providing the $1.2 billion market capitalization with a solid asset-backed floor. The most critical variable for NAT is the time charter equivalent, or TCE rate. The company's financial results are hypersensitive to small shifts in freight rates. Using the 2026 share count of 212 million, the impact of a $1,000 per day change in the fleet-wide TCE illustrates why the recent jump to $55,000 per day is so significant. If the historical average TCE of $25,000, the current rate represents a $30,000 premium. This premium translates into approximately $1.02 in annual EPS, nearly all of which is available for dividend distribution under management's current philosophy. Conversely, a drop to $15,000 per day would eliminate nearly all profit and jeopardize the dividend.
Conclusion.
The investment analysis of Nordic American Tankers reveals a company that is currently operating at the zenith of its cyclical potential, but facing structural headwinds that will test its long-term viability. In the short term, the bull case is overwhelmingly dominant. The $9,000 daily operating cost, combined with spot rates exceeding $50,000, allows for massive cash flow generation and high-yield dividend payouts. The ongoing geopolitical disruptions in the Middle East and the displacement of Russian crude have created a high-for-longer rate environment that NOT is perfectly positioned to exploit as a spot market specialist. Investors seeking tactical, high-yield exposure to the shipping cycle should find the company's current performance highly attractive. As we look toward 2027 and 2028, the bear case gains substantial weight. The 18% order book to fleet ratio represents a significant supply shock that historically leads to depressed freight rates. NOT's commitment to 2 new buildings for 2028 delivery is a necessary step for fleet renewal, but comes at a time of historic high yard prices and potential market oversupply. Furthermore, the company's history of share dilution remains a significant risk factor. Should rates soften, the management may once again turn to equity markets to maintain liquidity or fund its 2028 obligations.
Nordic American Tankers is not a buy-and-hold investment in the traditional sense. It is a highly leveraged, cyclical vehicle designed for the distribution of spot market profits. Its primary value proposition, the 114-quarter dividend history, is a reflection of its commitment to shareholders, but also its inability to retain the capital necessary for structural growth without dilution. The current investment thesis is therefore one of cyclical harvesting. The company is benefiting from a unique convergence of low vessel supply in 2026 and high geopolitical disruption. However, the impending arrival of the 2027-2028 order book and the secular threat of peak oil suggest that the current high-rate environment is a temporary peak rather than a new permanent plateau. Investors in NAT must maintain a disciplined focus on Baltic Dirty Tanker Index trends and global refinery utilization. The company's low break-even point provides a safety net, but its aging assets and history of dilution create a ceiling for long-term capital appreciation.